Good morning, hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Vivek Iyer and with me is Vinny Motiwala. Good morning, Vinny. Vinny, at the start of the session, in fact, till around half an hour, all of the indices were actually trading the green. What's transpired over the last 15-20 minutes is that there's been a bit of selling pressure that's emerged at higher levels, and in fact the mid-cap and small-cap indices are now trading with cuts.
Seems like the mid-cap, small-cap is also flickering a bit between the red and the green. They've not decided on which color they want. And Vivek, it's interesting to see, right? Like, because we open up in the green, but that sustaining part for the Nifty or the markets right now, that is something that is not happening, and I think that's what we're keeping an eye out on as well.
Quite a few stocks in focus. First up today, what's actually transpired is that the FMCG pack yesterday that saw significant selling pressure on the back of favorable macro data, CPI easing a little bit. You're actually seeing some of these names rebound quite smartly. So look at names like D-Mart, look at names like VBL. These are some of the stocks that have actually recovered quite smartly from the kind of sell-off that you saw in yesterday's trading session. The other stock that's seeing a bit of selling pressure is Bharat. We'll discuss that a little later on the show as to what exactly has transpired. But some developments in the US seen as a slight negative as far as Bharat is concerned. The stock now at the day's lowest point. Policy Bazaar yesterday was a top laggard. Today, the selling pressure has further intensified. And Bharat Electronics, remember, till 9 months FY25, the company was at risk of not meeting its order inflow guidance, but there's been a slew of orders. Seasonally, you do see Q4 as a very strong quarter for defense companies, and again, this particular stock amongst the top gainers as far as the Nifty 50 is concerned. So overall, defense is doing quite well. FMCG has rebounded after the sharp fall we saw yesterday.
Absolutely. And Vivek, some of these stocks, let's just talk about some of the names that have fallen down and have seen a further fall from the day's highest point for them. Affle India, that's seen a further fall coming in, and from the day's highest point, it's down almost 7%. So if you see Affle India's chart, yes, opened up in the green, and now look at it, day's lowest point is what Affle India is trading at. KEC International is another one, which is also seeing a further fall. From the day's highest point, it's down almost 4-5%. So that is interesting, and now the stock is down almost 5 to 6% in trade. So that is also trading at the day's lowest point. We have Sapphire Foods and SKF India. These are the similar ones, which are seeing some bit of fall coming in from the day's highest point and a lot of pressure from the day's highest point. Data Patterns, JB Chemicals and Godfrey Phillips, those are the names that are actually recovered from the day's lowest point and seeing a very good recovery. Look at Data Patterns. This is the flip side, right? They opened up in the red, these stocks, and now have moved to the green side almost at the day's highest point is what these stocks are trading at. Godfrey Phillips also trading with gains of almost 6% as of now. So that's how we're looking at it in terms of a move that is coming in for these stocks. Interesting to see where the benchmark indices are going to be moving, the mid and small cap. How is that going to be shaping up in the second half of the trading session now is the key to watch out for. But let's move on and talk about another stock, BEL. That's in focus today. It's a top Nifty gainer after the company has bagged an order of around 2,400 crore rupees. More details on this order we'll get you from Upasna, who's here to tell us about that. Upasna, good morning.
Good morning, Winnie. Well, it looks like a good month for BEL. The company has announced a slew of orders in this month. Now, the company has received yet another order, significant order, I must say, for fully indigenous Ashwini radar from IAF, that is Indian Air Force, worth nearly about 2,463 crores. BEL has received order inflows of nearly about 7,200 crores in Q4 till now. Mind you that the company in its Aero India conference has reiterated that the order finalization worth 12,000 crores are expected by 31st March of this year. Now, FY25 order inflows till now stands nearly around 17,000 crores versus 25,000 crore guidance, order inflow guidance for FY25 guided by the company. Now, looking at the valuation, BEL currently trades at 27 times FY27 PE. And mind you that the company's key focus is on diversification with a medium-term goal of generating 25 to 30% of revenues from its non-defense segment. Now, on the back of this order win, Phillip Capital maintains an ad rating with a target price of 390 per share, and Nomura has also said that the company is on track to achieve its guided order inflows is what it believes, and it is in the final stages of multiple negotiations with the customers. So all in all, a positive news for BEL. Hence, we can clearly see the stock surging in trade today.
Thank you so much, Upasna, for joining us and telling us about what's driving Bharat Electronics in trade today. All eyes will be on whether in the remaining few days that's left as far as Q4 is concerned, whether the company can go ahead and meet its order inflow guidance for FY25. But the other stock in focus, and that's doing very well in the session, is Adani Green. It's surging on the back of a note from Macquarie Capital. Sudarshan joins in with more details.
So Adani Green, basically yesterday there was something coming out from JP Morgan. JP Morgan had increase its two bonds, that is RG Group bonds, to overweight from neutral. So yesterday also you would have seen the Adani Green was up around 3%. Today Macquarie has initiated coverage on the stock with an outperform call, and target is 1200 per share, implying an upside of almost 40% from current levels. Macquarie says that it's leading India's energy transition, and total capacity that company is targeting by FY30 is almost 5 times more than the current versus the current capacity of 12 gigawatt. Conservative pathway implies 25% EBITDA CAGR over next 5 years, and it expects company to generate $1.8 billion annual operating cash flow. And despite the high capex, it believes that net debt to EBITDA will be declining to 5 times by FY30 versus 7 times that company currently has. And the second stock that I want to talk about is Bharat Forge. So first I want to say what's exactly the news. EPA administrator. EPA is basically Environmental Protection Agency of US, and that has announced rollback of certain environmental regulations. Now, how this is going to, and those rollback of environmental regulations also include rules related to emission standard for vehicles. Now, why Bharat Forge is in focus? So, recently in one of the JPM conference, Bharat Forge has said that because of these regulations, Class 8 orders in H2 might see a significant increase. Now, Elara has come out with a note, and it says that if these regulations are rolled back, so CY26 volumes for Class 8 will be normalized one, and also there was an expectation that in CY27 there might be a steep decline in Class 8 truck orders. That also may not happen. And Class 8 currently contributes 15% to Bharat Forge standalone revenue and 8% to consolidated revenue. Because of this, you are seeing a downtick in Bharat Forge share. It's down currently around 3%.
Okay, Sudarshan, thank you so much for highlighting those important updates for us. And Bharat Forge also trading near the day's lowest point as of now. So keeping an eye out on Adani Green as well as Bharat Forge. But on that note, we're going to slip into a very short break, viewers. Don't go anywhere, because after the break, we will discuss what is happening in the world of commodities. Which of these commodities are buzzing today?
Welcome back to Trading Hour. Well, a couple of stocks on the radar. First one, something that Sudarshan just spoke about a while ago, is Bharat Forge. That stock trading near the day's lowest point. And Motherson Sumi, the other auto ancillary stock, that too has now dipped and now slipped and trading near the day's lowest point. One stock from the NBFC space, a stock that's seen significant upmove and now trading near the day's highest point, is Aavas Financials. This stock, remember, has seen quite a bit of selling pressure, but today there's a bit of a bounce back. We understand that there's a report that has come in from Avendus Spark upgrading this particular stock. So that stock is now up over 2.5%. Aavas Financials is the one that we're talking about. But let's now shift focus to the commodity space. Manisha joins in, and today we're focusing on zinc.
Thank you for that, Vivek. Well, yes, we are, because we have seen the prices trade at around 2-month highs. If you look at the previous 1 month, we've seen the prices of zinc gain up by nearly 3%. There are 4 exact reasons, and these are supply concerns which have been supporting the zinc prices on the higher side. One is that Australia's Nyrstar has said that they will cut output by nearly 25% due to ore shortage going forward. So that is one. Second is that the latest data that has come in for 2024 shows that 2024 was a 3rd straight year that the global markets have seen mine production continue to decline. The third point is about the Red Dog mine, and this is in Alaska, which is slowing down due to ore depletion. Red Dog mine, remember, produces nearly 10% of mined zinc in the world. So this is going to be a big number coming in from that particular mine. And the fourth point is that the high-grade zinc LME inventories have continued to decline. The latest data shows that they're down by nearly 74,000 tons now at just about 160,000 tons. So supply disruptions, declining inventories, increasing cost of production, all of that really seems to be taking the prices higher.
Okay, Manisha, thank you so much for that. Surely keeping an eye out on zinc there as well in the world of commodities. But on that note, let's slip into a very short break. I beg your pardon. We'll come back and discuss market technicals with Shivangi Sharda from Motilal Oswal Financial Services, and also discuss their top bets coming in there in the trading ideas. Welcome back. Thanks for staying tuned into Trading Hour on CNBC-TV18. Nifty is back above the 22,500 level. We're seeing a bit of a spike up coming in the last few minutes for the Nifty 50, as of now holding on to gains of 0.2%. Now, earlier in the day, we spoke to Nilesh Shah, Managing Director and CEO of Envision Capital, who shared his insights on the market outlook. Let's listen into what he had to say.
In the very short term, we're going to be correlated with the NASDAQ and the US markets as far as the big IT companies go. I think currently the large cap names are trading currently at 23, 24 times trailing earnings. Probably I would still think there's a bit of a downside to the large cap IT names. However, having said that, clearly the big opportunity is in the tier 2, tier 3 IT companies. Clearly believe that those companies which will work on developing their own agentic AI solutions will be the big winner for the medium to long term. And I think that's an opportunity which can give them strong double-digit kind of growth over many years. I clearly believe there are no strong reasons for India market to be in a bear zone. I would still think from a medium to long-term perspective, it still has to be the mid and the small cap. The mid and small cap companies are growing at a faster pace versus their large cap peers. They're becoming more capital efficient. The access to markets, their access to capital has kind of improved quite significantly over the last few years, which clearly puts them in a very vantage position. Given their relatively smaller size and being very strong in several niches, gives them basically a strong tailwind of growth. So clearly, the space to be in for medium to long term is the mid and the small cap kind of space. The large caps have been struggling with growth. I mean, whether you look at large cap IT companies, large cap FMCG companies, large cap banks, they have been growing below industry growth. They are the guys who are getting challenged by the challengers, and therefore are essentially kind of have been reporting very tepid growth. Growth opportunity is the domestic space where they have the opportunity to go ahead and keep garnering market share and keep growing at double-digit rates. So I clearly believe that this correction that we have seen of about 30 to 45% in digital platforms or digital companies clearly is not just great from a risk point of view, but is also great from a growth point of view. FMCG companies, but maybe again the smaller consumer product companies which have strong basically niches. I also believe that over the next few years, consumption will remain relatively resilient, especially with the initiatives in the most recent budget and then some of the other direct benefit transfers which state governments are doing to consumers. I think a combination of all of that will leave more spending power with consumers, and a couple of categories which I think will remain standout categories will be the alcobev space, and second is essentially the beauty and personal care segment. Many other players in this space, hospital companies moving into insurance companies. Here is an insurance distribution company trying to kind of get into healthcare to improve the consumer experience. So I clearly believe that it's honestly not a very material kind of event. Unfortunately, the market sentiment is not really the best right now, and therefore these are probably being looked upon as markets as being some bit of a distraction kind of thing. But I honestly don't think this poses any kind of a structural headwind to their medium to long-term growth plans. And I don't see that as an issue of any serious capital misallocation.
Well, there are some views coming in, from Nilesh, especially, the important bite coming in as far as PB Fintech is concerned, but the stock continues to see a sell-off for the second straight session. It's now time for a short break. We'll get you more on the markets on the other side. Welcome back to Trading Hour. Well, as promised, it's now time for a technical check on the market. Shivangi Sarda from Motilal Oswal Financial Services joins us for a quick technical check. Good morning, Shivangi. Thank you so much for joining us. What are you making of the markets at the current levels? The Nifty Bank holding in the green, but the broader end of the market seeing some pain.
Very good afternoon, Vivek. So we've seen that, the Nifty index has been consolidating in a very consolidative band from the last 5 trading sessions. And of course, we've seen that even though support-based buying is intact, but follow-up is missing at the higher zones. And a lot of call unwinding is yet to happen at 22,600 zones for the next fresh leg of rally to commence. So we are looking at buy on decline strategy because Nifty is holding on to crucial support levels. Now we are looking at 22,330 as an important support level for the upside move towards 22,750 marks. Of course, there is some sort of lackluster move, but overall texture of the market remains positive to range bound. Now, talking about Bank Nifty, we've seen that underperformance continues here, but the good part is that heavyweights have been contributing to this rate-sensitive index. And there has been a good pullback move in the last 2 trading sessions after, it sank to 47,700 levels. But right now we're seeing that, there has been some sort of recovery and stableness here as well. So 47,700 would be an important support for the immediate term basis. And on the upside, we're looking at 49,000 levels for Bank Nifty. Of course, the conviction is more on the Nifty index as compared to this one.
Right, Shivangi. Good morning. This is Vinny joining in here as well. Shivangi, any top technical bets that one should be looking at right now in this market?
Yes, Vinny. So I'm looking at, Indigo as the first pick on my radar. It has been resilient in such kind of a market volatility as well. And positionally also, the stock has been making a pole and flag pattern formation on the monthly basis, on the verge of a good breakout here. And, the yesterday's sessions has witnessed a price volume surge, which confirms the ongoing up move. Also, we've seen a halt at the, earlier this week at the higher zones, which indicates that, there has been some sort of buying interest, which will continue over here as good levels have been retraced. So next targets that we're looking at is 4,900 for Indigo with a support of 4,600 zone. Now, the next pick on my radar is Bajaj Finance. Financials, of course, has been one leg of the entire banking space, which have been holding quite well. And this one particularly has been holding above its key exponential moving averages as well. From the last 16 weeks, we've seen that it has been trading in an upward sloping channel, and it has come out of its consolidative band, broken out of its higher base of the last 40 months. So definitely quite a good trade here. So recommending a buy here. Now, the next targets that we're looking at is 8850 levels for Bajaj Finance with a support of 8300 levels.
Thank you so much, Shivangi, for joining us, and wish you and the team a very happy Holi. Well, moving on, as we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back to Trading Hour on CNBC TV18. A quick look at what the market is doing right now, because we've seen a fall coming in the market, a sharp one that too. So look at it, Nifty is almost near the day's lowest point when you're looking at. It's slightly bit of the negative bias that we're looking out for. 22,466 is what the Nifty is trading at. Keep an eye out on that one. Important to see. So we've started seeing that fall coming in. It's not managing to sustain the recovery it's trying to make. And again, we're seeing a fall. A few of the stocks that we're seeing a fall coming in. First, Sauce. Let's pull that up as well. That's seeing a 2% decline in just the last 1 hour. We've seen a bit of a fall coming in on that front. Other than that, we have Century Textiles. That's also under pressure. See that also. First saw at the day's lowest point. Century Textiles, let's pull that up as well. Almost near the day's lowest point is what that is also trading at around. Down almost 2% in today's trading session. Info Edge, Thermax, some of these names which have seen a further fall coming in this last hour, especially of the trading session. But yes, that's how the market is looking right now. A fall that we've seen coming in overall in the benchmark indices. But let's bring on board Rakshit Ranjan, portfolio manager at Marcellus Investment Managers, joining in with us to discuss market fundamentals and his top sectoral picks. Rakshit, good morning. And just before you're joining, we're seeing that fall coming in the market. This sustenance of level doesn't seem to be happening. But overall, for the markets, what are we seeing, right? What are you expecting going forward? A lot of factors that are at play, right? Trump, tariff, and since then, those uncertainties, geopolitical tensions are there. Earnings growth haven't been that much in terms of Q3 for the performance for India. So in Q4, going forward, is there any positive sign in the near term, at least, that what we could watch out for?
That's a very good question. Good morning. I think when it comes to the point about earnings growth, there are two things that we see changing in the next 2-3 years compared to the last 2-3 years. First and foremost, in the last 2-3 years, there were many cyclically high earnings growth areas of the market leading to a more broader stock market earnings and stock market performance. Going forward, I think it should be far narrower because the importance of moats, importance of sustainable high quality earnings, it was far more diluted in the last 2-3 years than how we see playing out in the next 2-3 years. So that's certainly a segregation of call it the boys from the men, or call it companies that have strong moats and hence earnings growth from the rest of the market. I think that's certainly going to be one change. The second related change in over the period FY22 to 24, those 3 years, 22, 23, and 24, for an index such as Nifty 50, the earnings growth was north of 20%. That's higher than long-term averages. That's higher than what, let's say, the broader economy plus the premium for the larger, more surviving businesses in the broader stock market, etc., as a pack should demonstrate. This piece of cyclically high earnings growth should, in all likelihood, mean revert to bring the overall market's earnings growth over a longer period to the long-term averages. So with these two changes, I think FY25, as you rightly pointed out, being a case in point where Q3 was, I think, mid-single digit earnings growth for the market. Even the entire 9 months of FY25 has been mid-single digit for the market.
Right.
Quality earnings, quality companies-oriented earnings
Right.
are significantly ahead of the broader market. I think that's a trend which should continue into the future.
Rakshit, take that point completely. Rakshit, so in the current scenario, given the kind of market fall that we've seen, especially, if you're looking at the broader end of the markets, there has been significant price correction. So valuations have moderated. So at the current juncture, which are the companies, which are the sectors that you like, and where will you look to incrementally add positions?
Yes. So look, valuations moderated in areas where there was a lot of froth. I wouldn't expect them to participate in the recovery. But valuations moderated in areas where underlying businesses are allocating capital very aggressively despite a weak macro. Those are the areas where I think we'll be putting our money more and more. There are certain sectors, certainly. So, for instance, healthcare, for instance, CDMO pharma exposed. There's some of these sectors where macro headwinds aren't meaningful despite what we are seeing happening around us. Those would be a little bit of a sectoral calls, but otherwise, bulk of the calls that we'll be making will be stock-specific, bottom-up, they might be retailers making more money than their competitors. They might be manufacturing plays allocating capital in very disruptive ways and hence making more money than the broader economy. Those company-specific areas is where we'll be focusing far more rather than just sector pickings.
Okay, company specific is the way to go rather than sector picking is what you're highlighting. Just a word you did highlight, on those macro data or geopolitical tensions, which may not be a lot more. I want to highlight two sectors in that, right? We have pharma as well as obviously we have IT services also. I just want to understand from the US perspective side, right? From pharma or IT, is that both that you would look at, or maybe one is more favorable in this current scenario?
Both we'd look at, but not for the reasons only related to rupee depreciation and hence export orientation. Those are at best catalysts from a near-term perspective. They are not drivers of sustainable earnings growth. As in, rupee depreciation shouldn't be in a 3-year, 5-year time horizons investment hypotheses for any company. So yes, both pharma and IT services are part of our coverage because they are highly cash generative sectors, the highest quality companies. They churn out gazillions of cash flows, and those cash flows have a potential for redeployment. Wherever that redeployment leads to newer initiatives, disruptive initiatives, that's where I think there'll be growth, not across the sector because again, there are too many offsetting factors, too many factors at play, not just rupee depreciation and hence exports.
You take that point, Rakshit. So, especially when it comes to a couple of sectors, pharma, the other sector, auto ancillaries, even metals, all of them are also most likely going to be impacted by reciprocal tariffs as far as the USA is concerned. Have you formed a view on what could be the likely impact of tariffs on these sectors? And would you wait till there is complete clarity, or would you start cherry picking a few names now?
No, we have started to bear those in the risks that should get reflected in allocations of all companies in our portfolio, and hence again the larger allocations are companies where the moat is so strong and the exposure is reasonably protected from tariffs from the US, etc. Allocations to those kinds of businesses are higher. Wherever we see bigger risks from either domestic economy or the tariffs, we've taken money off the table in the last 3, 4, 5 months.
Right. Rakshit, what's your thoughts coming in on the financial side, right? On whether you have the banks or the NBFC sides on the India front and the domestic front. Anything that you would be looking at here or where you think there's a lot of growth potential here? And would it be more on the larger side of these companies or mid-cap companies is something that would look in this space?
Yeah, so in the banking side, there's been a bit of a positive surprise on asset quality progression in the last few months beyond, let's say, the MFI book. So personal loans, for instance, haven't yet shown the kind of red flags that you might have otherwise expected in a weak economic scenario. So that's certainly putting the broader lending space in a relatively better position than otherwise you would expect it to be. But given the weakness in the external environment, I would say again, we at least. Being very risk conscious on fundamentals, we would position ourselves to companies with very high asset quality. For instance, large private sector banks, only a couple of large NBFCs where we are not worried about asset quality issues. At the same time, they have the benefit of sort of increasing deposits. They have the benefit of market share gains if the external environment becomes difficult for everybody to operate in comfortably. So maybe a couple of large, high-quality private sector banks and 1 or 2 large NBFCs, rather than exposing ourselves to the risk of asset deterioration, market share losses because of weakening balance sheets, so on and so forth.
Thank you so much, Rakshit, for joining us, giving us your views on the market and on various sectors. Well, it's now time for a short break. The management of Coromandel International joins us next to discuss their recent acquisition and the way forward.
Welcome back to Trading Hour on CNBC-TV18. Let's put focus on Coromandel International as the company is set to acquire 53.13% stake, and this is in NACL Industries for 820 crore rupees as it aims to consolidate its position as the leading crop protection player. And to discuss all of this, about the synergies coming in from this as well, we do have the management joining in with us, S. Sankara Subramanian, MD and CEO at Coromandel International, to talk to us about this. Good morning, sir. Thank you so much for joining in with us on the show, and an interesting inorganic route that you've taken. And this is surely going to be helping the company in terms of a crop protection side of the business. First, just about this acquisition that you all have taken, you all are going to be acquiring 53% stake in NACL. So, one, what are the synergies coming in for this? When do we start seeing the synergies? And also in terms of the top line synergies that you will see.
Good morning. Thank you for talking to us. Yesterday, Coromandel board approved the acquisition of 53.13% stake in NACL Industries, leading agrochemical player. As you all know, Coromandel is a large fertilizer player in the country in the phosphatic segment. Besides that, we do have a sizable crop protection business with a top line of 2,500 crores. We are into both active ingredients manufacturing as well as formulation play. So we have been looking to consolidate this business and been investing in this business in the last few years. We have recently announced expansion of capacities and also putting up a multi-purpose plant. And also we have been introducing new molecules in the domestic market. We have a significant play in the export market as well. We have presence in Latin America. As part of our strategy, we have been looking to grow this business through inorganic route. Basically, one of the main reasons being it takes time for this business to introduce product into the market due to registration and setting up facilities and also for the product innovation. So in order to accelerate the growth plan, we have been looking for inorganic opportunities, and we scanned the market, and we realized that Nagarjuna Agrichem has been a pioneer in manufacturing of key active ingredients, been doing this for the last 3 decades. Has got the strategic fit with what we are looking for in terms of the spare capacities, what they have in their facilities at Srikakulam, and they also put up recently a technical grade facility at the Dahej. Besides, they have centralized R&D center near Hyderabad. So we felt that they are also in the generic space, and they are the state-of-the-art facility put up recently, and we look to grow. So we thought it makes immense business sense for us to go to market much faster and ahead of time. So that's how we looked at this. And we could see a lot of energy benefits in terms of sourcing, in terms of capacity utilization of their plants. They have ideal capacities. Where we have challenge in our plants where we have reached the full capacity utilization, as well as the product pipeline in both the plants can be effectively managed to go to market much faster.
Right.
So these are the thinking behind our investment.
We get that. So we get the rationale, that why you've done it. We also understand that there could be synergy benefits. We also understand that you're looking to go ahead and ramp up capacity utilization at the acquired facilities. Now, talk to us about the valuation at which this particular deal was done. Tell us the methodology in which the valuation was arrived at. We understand that it was done at close to 1.2 times FY24 sales, and you've also assumed some debt, debt of close to 520 crore as far as the acquired entity is concerned. Will you go ahead and look to assume the debt totally, or will you look to extinguish the debt going forward, and eventually will you look to delist NACL?
In terms of the valuation, I would say we have given a reasonable pricing. Our approach has been not to look at the 1-year performance. As you all know, the agrochemical sector was going through headwinds in the last 2 years, the global commodity prices softening. Most of the companies, including NACL, had this impact. So it's very impracticable to look at 1 year performance to arrive at the valuation. As you know, that NACL has performed reasonably well and has been growing steadily until 22-23, where they've reached close to 2,000 crores of top line with a EBITDA of 190 crores plus. So this company has got the capacity, company has achieved the revenues, and it has got a product range. It's a significant player in the formulation business, and some of the brands have significant volume, and they have presence across India in various key states. Looking at all these and the potential what they have and the synergies what we can leverage, the current the equity value of 76.7 rupees per share on the equity base translates to equity valuation of close to 1550 crores, and a debt of 350 crores translates roughly to 1900 crores of enterprise value. And looking at the potential EBITDA, which can be ranging between anywhere 150 to 200 crores on a steady state basis, this roughly translates to 10 to 11 times of EBITDA multiple, which I feel, going by the current trading, which is the lowest level, is quite reasonable, I would say. In terms of the rest of the points, what you raised, whether the debt will remain, obviously the company needs more money, the debt will remain, and Mallappa and Coromandel coming in there, obviously bankers will be more than happy to extend facilities to revive the business back. And what we need to do is to turn around and put it back and achieve the numbers what they have achieved, and then try to realize the synergy benefits and grow this business much bigger than what it is currently now. So at this point of time, we have no immediate plans on what do we do with the company. It will continue to run, of course, with the management input and expertise and the financial support from Coromandel.
Right. So just one question I want in terms of the margins, because NACL's margins, EBITDA margins have fallen to 1% is what I'm seeing in FY24. This is the number that is there. So how does that overall impact in terms of the margins of the company, the crop protection business, and overall the mix of the company? How will that also change?
See, currently they've gone through the bad patch in terms of the certain molecules that they had, and they've gone down from what 9 to 10% they used to make. They've gone down to 1%. Our immediate aim would be to restore it back to 9 to 10% what they have. And they also have pipeline of products which can fetch them better margin, close to 15%. They've got the final stage in terms of certain intermediates which they are working with global players, which can change the margin profile going forward. And looking into Coromandel capability to raise the margin in terms of the sourcing efficiency, in terms of the better market pricing strategies and the global market access, we are reasonably confident that this can only improve. But our immediate aim will be to restore it back to the margins what they have been achieving, and then try to change the product portfolio and improve the margin structure both in domestic and global markets. So we are reasonably confident to do this. Just to draw parallel to what Coromandel does, our EBITDA margin is range of 14 to 15%. We do have specialties. Our focus will be to introduce the similar type of product portfolio in NACL as well.
And any aspirations as far as export market is concerned? They had close to 24%, of total top line coming from exports. Will you look to ramp that further?
Absolutely. In fact, Coromandel has got a significant presence in various countries besides Latin America. And Nagarjuna has got global alliances with the leading players, and they have been manufacturing for them. So it's a win-win for both the parties, and we'll be able to distribute their technicals. They have close to 12 to 13 technicals. We have 13 technicals, except for one molecule, there's no overlap. So we have a complete range of 24 active ingredients, which we can definitely leverage on our network as well as their relationship on global players. And definitely we'll be looking forward to grow the export business as well. But not to forget, India is a large market. In fact, close to 30,000 crores. Indian industry is growing well for the agrochemicals. And they have very strong brands. They have got good reach in the retail and the distribution network they have. And definitely we look to synergize and integrate it. And that's a way forward. It will not be one single segment. It will be a combination of exports as well as domestic formulation plus the B2B. The best advantage what we have is the long-term relationship they enjoy with the key global players. That will give us an access for our strategic way forward what we are looking at and CDMO opportunities. This opens up the new window of opportunity for Coromandel as well.
Mm-hmm. Okay, sir, thank you so much for joining in with us on the show today, explaining us your recent acquisition that has come in. Thank you so much for that. But viewers, with that, we're absolutely out of time on this edition of Trading Hour on CNBC-TV18. Stay tuned in. Halftime report up next.